Welcome to today's webinar on how to think like a bank to increase your net worth. Okay, what we're going to talk about today, so different investment options that are available to you, what the banks are telling us about different asset classes, how this knowledge can help you achieve financial freedom faster. And we're going to lay out a bit of a plan of what we have done ourselves. So what myself, Nick Lee, and several of our clients have done using the same strategy and strategic mortgage advice. Why do we want financial freedom? Well, we find most of our clients end up in three categories. They're trying to increase their net worth. So maybe your goal is to pay your current home off in 10 years or 10 years faster than what your current 25, 30-year mortgage looks like. Maybe you're thinking about your children. So you want to put your kids through school debt free, or you maybe want to give them that first down payment on their home. Or retirement. Maybe you're thinking about building extra wealth to retire earlier or to have a better quality retirement when you get there. But those are typically the reasons. Overall, I think we all want financial freedom, but we all just have different reasons why. Here's myself and Nick Lee. We are mortgage brokers. We have several years experience, and we work with 58, actually, I think we work with 59 lenders now. We provide strategic wealth building mortgage advice. So it isn't just about getting a mortgage or getting a rate. There are things that you can do inside that often people do not realize that can set you up better for financial success. We are also very good at this. So here's a whole bunch of awards that we won in the time that we have been doing this. I always think to myself, am I doing the best I can with what I have for my children? So my goal is always my children. This is my family, my husband and my kids. And I always think like, am I doing the best thing I can possible with my money and my time to be able to set them up for the future or set me up for financial success so that I have the ability to support them in the future? A little bit of a disclaimer, right? So I'm going to present you some numbers, some situations. I'm a bit of an example of where we're going and potential plans that might work for you. They are based on the interest rates at the time that I recorded this, but at the end of the day, interest rates go up and down, markets change all the time. The growth figures we used are based on like third-party sources, based on historical data, but that is readily available to anyone. And lastly, like this is my opinion. It has worked for me. It has helped my family be in a place financially that we never would have been otherwise. And it can work for you. It's worked for tons of our clients, but it may not be right for everyone. It's also not based on any one particular lender's guidelines. Remember, I said we work with 59 different lenders. They all have different policies, comfort levels, regulations, little like fine print. So it's not like we work for one lender and we're saying, hey, bank ABC is the only place you can do this. There's lots of places you can do this. So let's think about different asset classes, right? So let's say you have $100,000 and you walk into your bank and your goal is to make another $100,000 in the next 5 years. Well, if you want to open a business, you say to the bank, I want to open a business. I have $100,000. They are likely to lend you $100,000. Okay, so you'll need about a 50% return on that business, which really sucks because like 86% of new businesses fail. And it is really hard when you're first starting out to get going. Now, let's say you say, okay, I don't want to start a business. That's too much work, which trust me, it is. Then you say, I want to just invest. I want to pick whoever your best financial planner is, and I have $100,000. How much money can I borrow to invest with your best financial planner? And typically, on the best relationship possible, they will give you one-to-one. So again, they'll give you $100,000 to borrow to be able to build up that portfolio. And so you'll need a 50% return to make that 100 grand over the next 5 years. What if you say, I want to buy a house? Well, typically, if you say, I want to buy a house and you have $100,000, they will lend you around $400,000. So now you have $500,000 to work with. right? To invest in a property and make sure that you can increase that equity over time. And you actually only need then a 20% return to be able to make that goal of that $100,000 in the 5-year period. So, which one of these does the bank treat as more or less risky in terms of lending? Well, if we look at the bank's money, they are giving more of it if you want to buy a property and less of it if you want to buy a business or own a business or get a business loan or be able to invest. So I am not saying that property is a better investment. I am presenting you with the fact that banks do this with their own money. And I'm asking you what they are saying with their lending decisions, right? For us to make money like the banks, we need to think like them, right? And if you think about the investment portfolios, like getting 50% return on your stocks for 5 years, like 10% every year. Has anybody done this? And if you have, honestly, like log off, like just go and keep doing what you're doing. You're good. Okay. But for the rest of us who are on, I want you to think about what the typical path most Canadians are on. So most Canadians buy a home and they pay the mortgage, the 25-year mortgage or the 30-year mortgage, and then they retire with that home paid off. Okay. So if you think about this house, right? This was the first house I ever bought, this little bungalow in Richmond Hill. Our initial investment was a $13,995 down payment, which is probably not possible in Richmond Hill today because it was quite some time ago. But I want you to think about 10 years after we owned that house, right? Um, it went up in value $305,000. How much overtime would you have to work to make that kind of money? And really ridiculously, because house prices go up and down all the time. Um, that was 10 years. But when we look at the 2 years we owned it between 2015 and 2017, right? Look at how much it went up there. Another $410,000. So owning this house for 12 years, it made us $719,957. It's pretty incredible when you think if I didn't own that house, I would have had to pay rent. I would have been in a totally different spot. Um, and here's the second house we ever bought, right? So this one, it was $20,000 down payment. It was a little farther out of the city, but a bigger home. And again, if you look at what the increase in this house went up over time, if you look at that 12-year number, again, the same as the previous slide, like this one's 650, so it didn't go up as much. But I mean, in 2 years, it went up $100,000. Could you imagine me working enough that I would make an extra $100,000 in 2 years? That would be wild, right? So basically, what I want you to take away from this is over time, can we all agree that homes go up in value, right? That they don't always go up the way we want them to, right? Sometimes you own it for 2 years and it goes up a lot. Sometimes it's going to go up at all. But if you own a home for a longer term, 10 years plus, uh, homes in Canada are always going up in value. So what if you had bought like the house next door when you bought your current home? So really think about that. Your current home has gone up however much it's gone up. Like in my case, say those were the 700 or 650. What if I had two of them, right? Well, at the time, I probably didn't qualify or I didn't have assets or I wasn't sure that I could do that. Um, Today, I want to present you with a plan to learn how to do better than that. So the path I want you to consider today is at a approximate 5% growth, prices will double every 15 years, right? So if we buy today for 500,000 with 500,000 financed in 15 years, we'll have $1 million asset with about $300,000 in debt. Okay, so that's a net worth increase over the 15 years of around $700,000. And what if we kept going and we bought 2 rental properties instead of 1. Well, that rule of 72 tells us that the property will double in value every 15 years. So instead of 1 rental, if you were a client and you bought 2 in the 15 years, well, then instead of your net worth increasing by 700,000, now we're increasing by over $1 million. And I know what you're thinking right now. I don't want to be a landlord. What if the tenants don't pay or they damage the property? I don't want to fix toilets in the middle of the night, right? And what what is the solution to all this? Well, to be honest, it's quite easy. Like you can get property management companies, really good ones, and insurance to cover all of these things, so you don't have to worry about it. And now I know what you're thinking. You're thinking, what if it goes bad? Right? You just heard me to tell you to borrow hundreds of thousands of dollars and you are worried about what could happen. And what I've come to learn over time is that the risk is not a factor of the debt I owe. It's actually a factor of 3 things. And what I have found is that with property, there is always appears to be more exit strategies than there is in the stock market. Right? Imagine that you owned a stock in that major car manufacturing company that was found to be lying about all their emissions tests. Everybody remember that? Yeah, what would your risk look like? And what would your exit strategy look like at the time? Well, that stock went down and there was 0 you could do about it. You could sell it low or you could hold it for a very, very long time and hope for the best. What about with property? So risk is typically a factor of demand, control, and exit strategies, right? So what is your exit strategies? Well, you can always rent a property. You can always sell a property. You can always modify a property. So maybe you want to change it into a duplex and then consider either renting it or selling it at a higher value. You could rent it to own it to someone else. You could improve it and increase the rent or sell it. And you can increase its value, appraise it higher, and pull more equity out to be able to survive, a downturn, a stressful situation, whatever it is. So lots of exit strategies, right? We don't see those situations where the stocks plummet and you're just done. You still have this beautiful asset of a home, even in your worst case scenarios of something going bad with a tenant or something going wrong, like a flood in your house or damage to the roof in a storm or something like that. We still always have this asset that can be improved or used to continue to generate cash flow or pull equity out. So we think about the compound effect, the power of owning just one investment property. If we think we bought it at 500,000 and we're using a 5% increase per year, right? Just as a really generic number. If you ask a realtor in your area, I mean, in the GTA, we see quite higher average growth than this, quite a bit higher, but we're using really conservative numbers here. So if you think about this, and we just owned another property for 5 years, the difference between purchase price and the new value of that home would be probably around $138,000, and you would have paid your mortgage down by maybe $40,000. So this would have an increase on your net worth by about $179,000, right? And remember, this is in a worst case scenario. Average growth is typically a bit higher. So think about, like, would you like a 25% return on your investment? Well, if you purchase an investment property for 500,000 and you invest that $100,000 in it, and then the bank lends you another 400,000, and then your property increases by 5%, and your $500,000 property is now worth about 525 in this scenario. So now think about that $100,000 investment, right? So that 20% of the 500,000, the potential increase in net worth, like I showed you with the compound effect, is about $179,000, right? If you owned it for 5 years. What if you owned it for 10 years? $400,000 isn't bad. And what if you owned it for 20 years? Then we're talking over $1 million increase in your net worth. And what if we owned it for 30 years, then we're talking a $2 million increase in your net worth after 30 years. Do you think that is worth any potential minor little thing that might happen? Of course it is, right? And this is really conservative numbers. So in that 5 years, you're looking at 190% return on your money. In the 10 years, you're looking at a 428% return on your money, right? In the 20 years, like this is getting crazy. This is crazy returns on your money, investing in property, which, I have explained to you, I believe is a safer asset class because you also have all these exit strategies and things you can do with it. So remember those three reasons why many of our clients want financial freedom. So increasing their net worth, um, helping their children, or retiring. If you think about paying off your mortgage in 10 years, if you owned another rental property, just one, for 10 years, you could potentially sell that rental property or refinance it, pull out money, and pay off your current mortgage in 10 years. Okay. What about paying for your kids' education? Well, for me, my kids are still young, right? Or helping them with a down payment. So I'm probably looking at this 20-year mark where I own a rental property for that long and then I sell it or refinance it and pull the equity out to be able to help my kids. I believe I could help my kids with $1 million, right? And build a net worth for retirement. If you're thinking 30 years out for retirement, maybe it's just owning one rental property. And the other thing I want you to think about is, what if you say, oh, no, retirement's only 10 years for me? Well, it might not be holding one rental property for 30 years. Maybe it's holding two for 10 years or three for 5 years, right? We can all have a different plan. But if you want to be on the $2 million plan for retirement, it's likely that it's acquiring some properties and letting them increase in value over time. Because the reality of living in one home and paying it off for 25 or 30 years will not set you up for retirement the way it used to. And don't panic, right? Like, this is not hard to do. We have helped many clients work this same plan. We have resources for you. We have great realtors that specialize in rentals. We have property management firms that can help you. We have all the trades if anything it needs to be fixed in a property. And we have financial planners and accountants who specialize in helping investors and know things like Smith maneuver and cash damming and all of that stuff that can help you. So in summary, when we looked at business versus shares versus property, property is where the banks want to put more of their money. And you have seen here how regular people can pay off their home faster, set up their kids for success, or build wealth through retirement. So what are the next steps here? It's really simple. You just book a call with us. This is free to anyone who wants to chat about their situation and see if there's an option for them. Is there a catch? No, there's no catch. There's no cost. Typically, we just do a quick call. If people are happy with what we provide them and they trust us to action out this plan we lay out for them, then we get paid at the time that we arrange your mortgage by typically the mortgage lender. If you have any questions at all, please just book a call. You can go to www.laframboisemortgage.ca, click on the top there, and let's chat. What I want to leave you with today is just thinking about, are you doing what is best with the time and money you have? Now that you know there's other options available, is it hard for you to not give us a call and see if you can do better? Thanks, everyone.